All right, y'all, give me a second. I'm about to make sure everything is good by going on another TikTok that I got and checking the audio real quick before I get started. Make sure everything is everything. Mic check. Mic check. All right. Welcome to the Ironworth Trading Show. I'm your host, Coach Price, and this is not financial advice. This is for educational purposes only. I had to make tonight a super fan chat only. So this is a super chat. They call it, I think, is a super fan live only. This is not a public live stream. You have to actually support me tonight to be a part of this one, or you might be able to catch the full live stream on YouTube. So go subscribe to me on YouTube. If you are not a super fan, okay? But this is a super fan only live stream. All you got to do is become a super fan and you'll be able to attend this masterclass, okay? Now, let me go ahead and share this out a few times too. Let me share this live out. All right, it's okay. Screw it. Here we go. All right, so let's get into it. Let's get into it, ladies and gentlemen. I want you to think about something for a second. All right, you've probably been watching a lot of trading videos on TikTok or YouTube. Maybe you didn't have mentors already. Maybe I've been your mentor and you still confused about order types. So I figured I'd double back and we got to go over this one again. So I'm gonna go over everything from how to set a bracket order, right? That's where you can set your stop loss and your take profit before you even get in the trade, okay? Or as simultaneously while you enter the trade. We're gonna talk about them all. All right, so maybe y'all know what a call option is. Maybe you know what a put is. Okay, this is for if you've heard about futures. If you feel like you getting it, but you still confused a little bit, this is for you. Now let me ask you something. When you go to actually place a trade, okay, I'm talking to you. When you go to actually place a trade, when it's time to click that button, do you know what type of order you supposed to use? Do you know what type of order you are supposed to use? Do you know if you should use a market order or a limit order? Do you know what happens if you get that wrong, ladies and gentlemen? Do you know what happens when you get that wrong? All right, so just think about that for a second. Because you don't know how to trade if you don't know order. You really you can't be a trader without knowing the order types. This is an important aspect of trading. Knowing when to use which order type. Okay? Now, here's the truth that a lot of trading courses, they skip right over this shit. you not about to be a trader without knowing what type of order you taking. You can't get out of a trade without an order. And if you don't know your order types, you pretty much flying blind, and you using real money to fly blind with. That's crazy. What up, Ava? What up? What up? All right, so I've seen people blow $5,000 on a single options trade, not because their analysis was wrong, but because they used the wrong order type. They hit market order on an option with the wide ass spread, and their money was gone just like that. Okay. Now tonight we're gonna stop that shit. We're gonna make sure we put an end to it. So by the time y'all leave this live stream, that's if you're a super fan. If not, you might only be able to get a preview. But it's okay. You might catch the replay on YouTube. But I gotta look out for my supporters first. So tonight we're gonna put an end to that shit. So you're gonna understand order types at a level that most people who've been trading for years still don't get it. Okay, we're gonna go from zero to expert, one layer at a time. That's what we're gonna do tonight. So we're gonna cover, if y'all can see my screen, order types. We're gonna go over what is an order type and why it matters. We'll talk about market orders, limit orders, stop orders, and that includes the stop loss and the stop limit. We'll talk about advanced orders, okay? OCO, which is one cancels the other. We got bracket orders, and we have the trailing stop. That'll be some of y'all best friend. We have time and force that we'll go over. I'm gonna go over options, specific order types, and I'm gonna go over order types for people that trade futures. All right, we're gonna talk about order flow and execution, and then I'm going to give you all a master cheat sheet that you can use at the end of the live stream. Okay, that'll help you out. Now, I'm not mistaken. You shouldn't have to do anything but hit the heart at the top of the live stream to become a super fan. Okay. If you want to become a super fan and be able to attend this masterclass, I don't blame you. It's going to be highly lucrative to understand, understand, and overstand the order types. You can't really be a trader without knowing this. All right. I don't know where else on YouTube or TikTok you're going to be able to get this information the way you about to get it tonight. But yeah, I only got about 10 slides to go over with y'all, but each one, okay? Each one is important. One big concept on each slide. We're going to make sure we cover one big concept on each slide. By the time we get to the 10th slide, y'all going to have a cheat sheet that I'm going to make sure y'all can screenshot or whatever you got to do that you can use every single time you trade, okay? With that being said, we finna go ahead and get into the show. What do we got? All right, what is an order type? Let me make sure everybody can see my screen, y'all. If you turn your phone sideways, you should be able to zoom in on the words if you can't read it, okay? But before I throw terms at you, I want to make sure we speak in the same language. So an order type is simply an instruction. An order type is you giving instructions, okay? It's the message that you send to your broker that says, all right, look, this is how I want this trade done. Not just what to buy or what to sell. You telling them how you want to buy it, under what conditions, or how you want to sell it, and under what conditions, at what price, and for how long. That's what an order type is. So think of it like you ordering food at a restaurant, right? You saying I want a burger, that's not enough. You want a burger? Eat a burger. I'm just playing. Listen, you need to tell them whether you want this steak medium rare or well done. Do you want no pickles on that shit? Right? Do you want it for here or to go? Same shit in the market, you being specific with the way you place that trade. So an order type is your specification for the trade. Remember that. And just like food, if you don't specify, you're going to get whatever the fuck they feel like giving you. You understand? All right. So look at, let's see. Every order type controls one or more of three things, right? We're going to look at the price. You see the price in yellow, the timing is in green, and the purple is for conditions. We're going to talk about the price. So at what price does my order fill? Do I get to name my price, or do I take whatever the market give me? Right? So keep that in mind. Every order type controls one or more of three things. One or more of these three things. Look at this. It's going to be the price. At what price does my order get filled? Do I get to name my price? Or do I take whatever the market give me? Also, timing. How long does my order stay alive? Does my order expire at the end of the day? Does it live for weeks? Does it need to be filled right now or canceled? You understand? And then we got conditions. Under what conditions, under what circumstances is this going to execute? Does it only trigger if the price drops to a certain level? Does it only execute if the entire order can be filled? These are conditions, all right? I would say anybody confused, anybody who asks questions, but this ain't that type of live stream. You have to be a super fan just to even comment on this live stream. So I wanted to make sure I get through tonight. Easy breezy. So look at the bottom of this slide that I got up here for y'all to look at. I want to show you the family tree. The order type family tree. Y'all see it at the bottom of the chat? I know y'all still can like the live. Tap the live if you can see that at the bottom of the chat or the bottom of the screen. Okay. So I want to show you the family tree. All the order types we gonna cover tonight. It's right here in this order type family tree. Don't panic though. Don't panic. It's cool. Each one has a job. Each one has a moment when it's the right tool that you should be using. Like, you would not use a hammer to screw in a bolt, right? So you shouldn't use a fucking market order when you trading options with a wide spread. It's the same idea. So we're gonna start with the basics and we're gonna build from there. Let's talk about market orders first. Let's go over market orders. Let's go over market orders. All right. The market order. This is the one everyone uses when they first start trading. This is also the one that burns the most beginners, okay? So, what is a market order? Here's what a market order does in plain English. You say, I want to buy this right now. And you get it, right? Immediately. You don't give a fuck how much. Look, I don't care how much it costs. Just get me in this trade. Or I don't care how much I get. Just get me out the trade. You gonna get this at whatever price the market is at. You have zero control over the price with a market order. But you are guaranteed you damn near guaranteed for your order to get filled. But you are not guaranteed on the price that you are getting filled at. Now look at the bid/ask example on this slide. Right here on the top right. Pay attention. If you can't see it, turn your phone sideways and zoom. You should be able to zoom in on it. Okay, so look at the bid/ask example on this slide. This is critical. This is what you actually see when you pull up an options chain. Okay, right here. This is what you actually see when you pull up an options chain. I don't even know if y'all can see my mouse cursor. I probably should have made the live stream able for y'all to talk. But it's cool. I at least should have left the comments open. Damn. It's all good though. So check it out. Y'all see where it say Apple 180 call? 180C, that stands for Apple $180 call. That means you think Apple about to go up to $180 or more. The bid is $4.80. The ask is $5.10. That is a 30-cent spread. Okay? But just to make it simple, we know that one contract is 100 shares. So that $4.80 is really $480. $5.10 is really $510. That's a $30 spread. Okay? Now, when you hit a market buy, you pay the ask. You paying the ask. You're not paying the bid. You're not paying the cheaper price. You're going to be paying the higher price, which is the ask. When you hit market buy, you are getting the ask. When you hit market buy, that's what the fuck you paying for right there. You paying the most, the ask. That is a 30-cent spread. You pay $510. When you hit market sale, you get $480. So when you getting out, you getting the smaller amount when you getting out. on the market price. When you getting out of a trade and you hit market sell, you getting out using a market order, it's going to fill you on the bid. You don't have control over whether you get out on the ask, right? Because you picked market. So here's where people get hurt. One contract in options. Let's say remember we trade in stock options. I'm gonna tell you from a futures point of view too, because I know a lot of y'all trade futures. But one contract in options controls 100 shares, right? So that 30-cent spread, that's $30 you giving away the instant you place a market order. Before the stock move, before anything happened, you just negative $30 because you didn't use the right order type. Okay, how many of y'all enter the trade and you start out negative? You ain't used the right order type. So let that sit. We want to let that sink in. Make sure y'all getting what I'm saying. Y'all make sure y'all picking up what I'm putting down. Now in futures, it's a little different. Where my tea at? Let me sip my tea. Yeah, in futures it's different. The spreads in futures are a lot tighter. You won't have to deal with them wide ass spreads that you do when you trade in stock options in the futures market. The E-mini S&P 500, right? The ES, it trades with a one tick spread most of the time. Okay, so one tick is $12.50 every time in futures. Every time it move one notch, literally, if it go up one tick, you make $12.50 if it go in the right direction. If it go in the wrong direction, you lose $12.50. All right, so I think it's $12 and might be 25 cents. No, that's about right. That's right. Because if it go up 4 ticks, that's $50. So if it make a $1 move, you made $50 or you lose $50. Every time the futures on SPY go up one tick, that's $12.50. 4 ticks, $50. All right. So the market orders can skip a tick or two. In fast markets, that's $25 to $50 gone instantly. So be careful with the market orders is my point. So the question is, when should you actually use a market order? If that's the case, when do you really want to use a market order? Well, you want to use a market order when you absolutely need to be out right now. I'm talking about when speed matters more than the price. You see what I'm saying? If you in a trade and the market is crashing and you need to exit, use a market order. Don't try to be fancy and shit. Just get out. And you want to use them whenever it's a highly liquid stock or a future. Apple, SPY, NASDAQ, okay, ES. You want to do it when the spread is pennies and the slippage don't matter. But never use a market order on options with wide spreads. That's one of the most expensive mistakes that you can make. I damn near need to do a whole masterclass on spreads alone. But never use a market order on options with wide spreads. Look to the top up here. I showed you this spread. The spread need to be about 5 to 10 cents, 2 cents, tight as possible. But 30 cents is crazy. Okay. Now, that's $30 right out the gate. Now, look at the bottom of this slide. Right here at the bottom where it says slippage explained. At the bottom of the slide. Slippage explained. Let's talk about slippage real quick. I really could do a whole show on slippage too, but we're not going to do that. Let's say you expect $5.10. You actually pay $5.40. Basically, you thought you was only going to pay $510 for that contract, but you used a market order and you ended up paying $540. That's $30 per contract gone before the trade even started working. You understand me? Now we're going to go to limit orders. We're going to leave market orders. And we're going to talk about limit orders real quick. All right. We're going to talk about limit orders. So this is the order type that professionals use the most. The limit order. Once you understand it, you will never think about trading the same. You'll never think about trading the same once you understand the limit order. A limit order lets you control how much you pay. A limit order is going to let you name your price. Okay, you say, hey, look, I want to buy this, but only at this price or better, not worse. And the market either gonna come to your price or it doesn't. If you the type of person that you like, it's your way or the highway, this is perfect for you. It's gonna be, look, hey, I want to buy this only at this price or better, not worse. Okay. If it does feel listen, the market either gonna come to your price or it doesn't. But if it does feel, you gonna feel at the price that you want it or better. Never worse. Never worse. That's the beauty of a limit order. So you get a trade-off, right? The trade-off is this. With a limit order, you control the price, but you don't control whether or not it gets filled. Okay? You might not get filled on that limit order, right? Let's keep that in mind. That market order, you more than likely guaranteed to get filled on that one. But with the limit order, you're not really guaranteed. You're going to get exactly what you wanted, but you might not even get it. With the market order, you're going to get what you wanted, but you're not going to get what you wanted. You're going to get out the trade, but it ain't going to be how much you want it. You see what I'm saying? But you wanted to get out the trade. You didn't care about the price. So look at the buy limit example on the left. Let's look at the buy limit example on the left, ladies and gentlemen. The stock is at $105.50, right? Now, I want to buy at $104. As soon as the price of this stock gets down to $104, that's when I want to buy. So I'm going to place my limit order there. And it's just going to sit there waiting. If the price pull back to 104, it'll get me in. If it never pulls back, my order just going to sit there unfilled. Now look on the right where it says the sale limit. Okay. Now let's say I'm long. That means I think I'm bullish. I think this stock finna go up. I done bought shares of it, and I want to take profits whenever this stock get to 108. So I'm gonna place my sale limit at 108 and go about my fucking day. I'm not gonna stick in front of I don't gotta sit in front of the chart. I can go, if you got a job, you can go on about you, go and do your work, whatever you got to do. You got kids, you can go and take care of the kids, be with the family, whatever. If the price rallies to 108, I'm out with my money, with my profit. That is called a take profit order, ladies and gentlemen. That's discipline built into the order. Do you understand? I don't even know why I'm asking y'all. Do y'all understand? I made it a super fan chat only. I think the only way you can even be in the live stream is if you are a supporter. So if you don't got a problem supporting, you'll be locked in. You can sit here through the whole masterclass, but it's gonna kick you out if you just a stranger. It ain't gonna let you stay long. You might get 30 seconds, and then it'll kick you out. All right, I kind of like this, but I'm gonna give the replay to all my clients. And if you in the Discord, I'll post the entire replay in the Discord. Now, we went over that. I wanted to show you why this matters so much in options. All right, that same Apple option, okay? The same Apple option. Look, options application. Look here. Look at the options application card. Okay. Now, let me show you why this matters. Bid 320, ask 360. That's a 40-cent spread. That's a 40-cent spread. So instead of hitting market and paying $360, I'm gonna place a limit right at the mid price at $3.40. Right? That's $340 instead of $360. Now I'm gonna wait. Now, usually in liquid options, whenever there's liquidity in the market maker is gonna meet you at the mid or close to it. So you just save $20 on one contract. If you trade 5 contracts, that's $100 that you save before the trade even moves. It's people out here overpaying for this shit because they don't understand order types. Please don't let that be you. So that's not a small thing. Over a year of trading, this discipline, like limit orders and options, can save you thousands of dollars. I'm telling you, professionals obsess over this type of shit. And when you trade in futures, let's say you trade in the mini spot, and the bid is at 4,582, and the axe is at 4,582.25. Place your limit at the bid price. 4,582. You save one tick, $12.50. It sounds like it ain't much, right? But do that shit 200 times a year. That's 2,500 in the savings just from you using the right order type. This matters, ladies and gentlemen. I'm telling you, this shit matters. Limit orders are your default. Make this your default. I'm using a limit order, especially for options. Okay, always. Now we'll go to stop orders. We went over market orders. We went over limit orders. We'll go over stop orders next. A lot of people get confused over these. So we're gonna if you still confused about stop orders, now is the time for you to become a super fan, right? Now, this is risk management, ladies and gentlemen. This is risk management. All right, we're gonna get into the order types that protect you. This is important. You might know how to get into a trade, okay, but that's only half of the equation. You knowing how to get into the trade is half of the equation. You also need to know how to get out when things go wrong, right? Don't you? And how to lock in profits when things go the right way. So there are 3 stop order types on this slide. Let me walk you through each one. I got you. What up, Akeem? What up, Ro? What up, everybody that's coming in? I appreciate y'all for stopping through, and I apologize that tonight is not a free live stream. Y'all know I do these free live streams all the time. So all you got to do is become a super fan, and you can watch the entire live stream. TikTok pretty much should tell you that. But yeah, it's all good. It's all good. I'll teach it again one day if y'all can't make it tonight. Anyways, let's say you in a trade and well, let me rewind it. Let me rewind it for a second. Let's talk about number 1. Let's talk about the stop loss. This my favorite one. All right, the stop loss, also called a stop market order. Okay. Now let's say you in a trade. Let's say you in a trade. If this goes against you, matter of fact, I'm gonna pretend I'm in a trade. Okay. If this goes against me and hits a certain price, get me out immediately. That's what the stop loss is saying. All right. If I'm in a trade and this shit go the wrong way and it hit this level, get me out. The moment your stop price is touched, your order converts to a market order and it executes. Okay? As soon as it hits the price that you picked, it's going to execute a trade. So you buy Apple at $180. You set a stop at $175. If Apple dropped to $175, your order is going to fire as a market sale. You're going to get out probably around $174.90 or something like that, give or take. Either way it go, you guaranteed to get out, okay? But you might get filled a little bit below your stop because it's a market order. That's the only fucked up part about it. That stop loss, that stop market order. Remember what I told y'all about market orders versus limit orders. So now we finna talk about the stop limit order, okay? This is the stop losses more sophisticated cousin. So when your stop price is hit, instead of converting to a market order, it converts to a limit order at the price that you specify. So you might say, stop price $175, but my limit price $174.50. So if the stock hits $175, a limit order goes in at $174.50. You will only feel between $175 and $174.50. But here's the danger. If the stock gaps through $174.50, your order doesn't fill, you still in the trade, you still losing money, you didn't get out. That happened to my friend JB, and we was trying to figure out what the fuck was going on that day, and Robinhood didn't fill her order. So stop limit gives you more price control but less execution certainty. You don't have the same certainty with executing that trade as you would with a market order that you have when you're using that limit order. So yeah, with that limit order, yeah, less execution certainty, more price control though. Now in options, where the gaps are common, because we do see a lot of fair value gaps when we trade in the stock market, this is actually the preferred stop because market stops on options can be brutal. But you got to be aware of the gap risk. Y'all got to know this shit gaps up and down. All right, now number 3, we're going to talk about the trailing stop because this can save you. This is beautiful. I love the trailing stop. I absolutely love the trailing stop. It's one of my favorites because it lets the winners run. That trailing stop gonna let you maximize your gains and minimize your losses. Okay, it's beautiful, fucking beautiful, dog. All right, let's say you bought. Let's say you trade in futures and you press buy. Let's say you trade in futures and you press buy on SPY. Let's say you trade in ES and you press buy at 45.80, 4,580, right? You set a trailing stop 10 points below. So the stop starts at 45.70 because you bought at 45.80. When you press buy, when you trade in futures and you press buy, you think the price is gonna go up. So if you got in at 4,580 and you telling it, okay, get me out at 4,570 if the price comes down, okay? Now let's say the price moves up instead of going down. So it don't go down and hit your stop loss. It actually goes up. Your stop loss will follow it. Now the stop loss is not at 4,570. It moved up with the price and it is now at 4,590. Price hits 4,610. Your stop moves up to 4,600. So it only moves in your favor. It never moves against you. That is why it's important to know if you don't, even if they don't give you the option to use a trailing stop, you can manually do the trailing stop. If you are in a trade and you think it's going in a certain direction and it goes in that direction and you had a stop loss, you should take that stop loss and make it closer to where you could break even or walk away with some money, but don't just leave it at the same level it was at and the price moved in your favor. Now, if price reverses and hits your stop loss, you out, but you locked in the profit from wherever you got in at to wherever the stop ended up at. The trailing stop is just gonna remove your emotions. It's gonna say, I'm gonna let this winner run and I'm gonna exit automatically when it starts reversing. That's it. This is how you actually be a disciplined trader, right? So yeah, just I do want y'all to write this down. I do want y'all to keep this part with y'all. In options, use stop limit orders, not stop market, okay? Because wide spreads make market stops too expensive. You don't, if it's a wide ass spread, you shouldn't be paying the most for it. You don't realize that you can get it for cheaper. You pay a shit ton for those contracts when you're not using a limit order, a stop limit order to get in or out. Okay, so in futures, stock market is fine because the spreads are tight. Okay. Now, what else we're gonna talk about the advanced order types. We're gonna move it right along. We're gonna talk about advanced order types next. Excuse me. Hot damn, it took me how long to learn this? Oh yeah, JB, I think I just spoke you up. I talked about remember last year we set a stop loss and it just didn't even fucking matter on Robinhood. It just the price shot right down. That's because it gapped. If it gaps past your order, it won't get filled. And that's what happens. Sometimes the price moves like that and it'll gap past it and it won't even get filled. All right. So we are going to go over advanced order types now. This is important. This is important. Now you're gonna be thinking like a professional, okay? So this is where shit get a little more interesting. This is where you go from being a trader who places individual orders to being the type of trader who engineers trades, okay? These are the order types that let you set up the entire trade. I'm talking about this where I want to get in at. This is where I wanted to get out at if I make money, and this is where I want to get out at if I'm losing money. This is how you trade before you even click one button. You done made 3 decisions before you even click one button. All right, so let's talk about the OCO. The OCO, it stands for one cancels the other. One cancels the other. You place 2 orders at the same time. Sorry, I'm going. You place a profit target and a stop loss. I got a new chair. I haven't put it together. I got to get out this squeaky ass chair. It's comfortable, but it's just squeaky galore. I know y'all tired. All my true fans is tired of hearing this damn chair squeak. But it's all right, y'all. I got a new one. I'm gonna put it together soon. All right, so this is where you go from being a rookie to actually, doing something. Now you place two trades at the same time, a profit target and a stop loss. Whichever one triggers first automatically cancels the other one. Think about how powerful that is. All right, you get in Apple at 180. You immediately place a sell limit at 195. That's your profit target. And your stop loss is at 170. That's your protection. Now you walk away. You don't babysit the screen. If Apple runs to $195, you out with a profit. And if the stop, and then the stock gonna cancel itself if your take profit get hit. But if Apple drop to 170, your stop loss gonna get hit, and then the take profit gonna cancel itself. Hence the term one cancels the other. OCO. OCO mean your trade manages itself. Once you in that trade, that's the difference between being a disciplined trader and someone who's staring at the fucking chart all day in panic mode. All right, next up on the list is bracket order. Now, a bracket order is pretty much an OCO order on steroids, right? So we know what the OCO order is. One cancels the other. Bracket order sounds something like the OCO order, but we're going to talk about the difference. So the OCO order pretty much two. The bracket order is three. It's three orders in one. Okay? Your entry order, and then the moment you get filled, it automatically places your profit target and your stop loss simultaneously. Okay? So when you trade in futures, this is essential. Let's say you buy, we have the bracket order. Let's say you buy ES for $4,580. Matter of fact, let's say you buy ES at $4,582. Your target is 4,602. That's 20 points. So you put your stop at 4,572. That's 10 points. Okay, so 2-to-1 risk to reward built in before the trade. You click once the entire trade life cycle is managed. So you pretty much got the whole trade figured out. Where you gonna get in at, where you gonna get out at, etc. That's for futures. That's for the people that trade futures. Either way it go, the bracket orders are the day trader's best friend in futures. You want to use them on every single trade when you trade in futures. Y'all blowing them accounts because y'all not using stop losses. Y'all, you see all the money you make and you don't take profit, or you see all the money you losing and you just could have cut it short before it was that big of a loss. You're not using bracket orders. All right? You're making your work a lot harder than it got to be too, because I'm pretty sure you staring at a chart. Like, you staring at a chart, making yourself work hard. Huh? Don't be a mouth breather. All right, so now, what do we got next? What do we got next? We also have the OTO orders. One triggers the other. 1 second, y'all. OTO orders. So we got OCO. One cancels the other. Bracket orders. All right. And then we got the OTO. One triggers the other. Let's talk about the OTO. This is for when you want to enter on a pullback, but you don't want to place the stop until you actually end the trade. So the stop only activates after the first order is filled. It's clean, it's conditional, but it's professional. It's professional. Ain't nothing more professional than knowing these order types. You got the rookies that don't know what the fuck they doing. All they know is market buy, market sell. Jeez Louise. They see a limit order and get mad waiting on that shit to get filled. Who the fuck get mad they saving money? You can't get mad you saving money, y'all. Come on. We don't get mad we saving money. No. We don't talk about Bruno looking at. Hold on, y'all. All right, so where was I at? OTO. Yeah. So, and then now we just go over the iceberg so we can get through with the rest of this live stream. Iceberg orders. These are what big institutions use. You want to buy 500 contracts, but you don't want to use the market. You don't want the market to see you buying 500 contracts. The iceberg shows only 10 at a time. As each slice gets filled, more appears, right? Like an iceberg. More of it is hidden underwater. You probably won't use iceberg as a retail trader, but you will see them being used against you in the order book. All right, now you know what that is. Let's go to um, market on open, right? That's called move. Market on open executes at the opening price. You won't have to worry about this. In the VWAP order, you can do conditional orders, which means, okay, if the price crosses this EMA, I want to get in. If it falls below this EMA, I want to get in. If price crosses VWAP, I want to get in. If it drops below VWAP out, you can set conditional orders. Now, we're going to talk about time and force. This is important too. This is something that confuses people as well. This is the missing piece that a lot of people never learn. All right, so time and force. I don't even think the teachers talk about this when they teaching beginners. I don't hear a lot of people talk about it, but I'm gonna walk you through it. It's all right. So we got the day order. That's the first thing on the list is the day order. Your order is active for today's trading session only. If it doesn't fill by the end of the day, it's gone. Canceled automatically. This is the default on most platforms. Okay, a lot of intraday trades use the day order. Next up, we got the GTC order. This is good till canceled. Your order will stay active across multiple trading days until it is filled or until you cancel it. Most broker cap this at 60 to 90 days. So I'm going to explain to you when you would want to use a GTC. Let's say you a swing trader. You think Apple is going to pull back to 160, but right now it's at 175. You place a buy limit at 160. You set it till GC. You set it to GTC and you walk away. It's going to sit there waiting for days, weeks until the price comes to you or cancels it. If you don't make sure that it is a GTC order, don't be confused when it's not there the next day. Okay? That is how patient, disciplined swing traders build positions. They don't chase a damn thing. If you chase something, it's running from you. They set their price and they wait. Now we're going to talk about the GTD, which is like the GTC, but you choose a specific expiration date and the order cancels automatically on that date if it's not filled. All right. GTD, good till date. Same as the GTC, but you picking the expiration date. Where I'm at. I think we on immediate or cancel. All right. So yeah, for the GTD, you want the order canceled automatically before earnings report. Set the GTD to expire the day before. Clean as hell. Now, immediate or cancel. This order must execute immediately. Any part that can't fill right now gets canceled. Partial fills are okay, used when you need speed, but also you want to avoid chasing. All right, then we got the fill or kill, FOK. Fuck! We got the fill or kill, all or nothing. The entire order must be filled immediately or it is completely canceled. Ain't no partial fills. A lot of this is institutional. This is used for large block orders where a partial fill is worse than no fill. All right, now look at the decision table. Look at the decision table. Where do we got it at? Right here. At the bottom of this slide. I want you to memorize the two most important ones. If you a day trader, use day orders. Okay? If you swing trading, waiting for a pullback entry, use a good till cancel with a limit order. This is for educational purposes only. Those two cover 90% of what you'll ever need. Fuck what you heard. Now, we'll go to options specific order types. I want to make sure that you guys, this is critical for anyone trading stock options. I'm going to do futures after I do this one. Excuse me. Now, a lot of options have some unique nuances when it comes to orders. And if you get these wrong, they're going to cost you a lot of money on every single time. All right. So always use limit orders. Never use market orders on options. Wide spreads equal instant money loss. Okay. Always use limit orders. Never use market orders on options, because you're dealing with wide spreads, and that is going to equal you losing money right away. Do y'all understand? Write that down. If you don't get shit from this live stream, I'm gonna say it again for the people that only get 30 seconds of my live. Listen, the golden rule for trading options is always use limit orders, never use market orders on options, because wide spreads equals instant money loss. All right. Now, let's talk about multi-leg orders, because when you start trading spreads, this will become essential as well. Now, the debit spread order. I know a lot of y'all probably ain't taking those spreads, but we going to talk about them. The debit spread order. When you buy a call spread or a put spread, I know some of y'all ain't doing that yet, but some of y'all just got started on it. We just did a class last week. VIP was doing this, the call spread. So when you buy a call spread or a put spread, you're doing two things at once. You buying one option and selling another. You do this as a single order with the net price. That's called the net debit. I'm going to say this again. The debit spread order. You are basically doing two things at one time. You buying one option and you selling another, but you're doing this as a single order. For those that sports bet, this would be like a two-leg parlay for you. So let's say Apple Bull call spread. Let's look at this example. Apple Bull call spread. You buy the 180 call. You sell the 185 call. Now the net cost is 240. You place a limit on the net cost, maybe 235 to 240. So you saying I'll pay up to 240 total for this spread, not a penny more. Now, why does this matter? Because if you leg into each option separately, right, place them as two different orders, you might pay too much on one leg while the other one moves against you. But doing it as one order eliminates that legging risk. Okay. Now let's move on to the credit spread order. Same concept, but reverse. You selling the expensive option and you buying the cheaper one for protection. Money comes in, you set a limit on the net credit. That's the amount you want to receive. I'll take this trade only if I collect at least $180. All right, then we're going to move to the contingency order. This one is powerful. All right, you set an options order to only trigger if the stock hits a certain price. Say you want to buy Tesla calls, but only if Tesla itself breaks above 200. So you set a conditional order. If Tesla trades above 200, then buy the $200 call. You never have to watch the screen. The platform going to do this shit for you. This is available on Thinkorswim, Tasty Trade. A lot of them let you do this. I think you can do it on Webull too. Mike can do it on Robinhood. But yeah, then you got the roll order. This is for options traders. When you got a position that's expiring, y'all ever wonder when do I need to actually roll a contract? Well, here you have it. When you got a position that's expiring or it need to be adjusted, you close it and open a new one in a single order. This prevents legging risk, and it usually gets you a better price than doing this shit separately. Look at this. Look at the example at the bottom. Look at this at the bottom. Step 1. This is how to place a perfect options order step by step. Step 1. Check the bid/ask price. Do y'all understand? Step one, check the bid/ask spread. That's the first step to placing a perfect options order, is you checking the spread. That's step one. Step two, calculate the middle. Figure out what's the middle of that spread. Step three, for multi-leg, use net debit or credit. Step four, set your time in force. Is this a good till cancel? Is this only for today? Step five, you want to use conditional stops based on the stock price. Step six, watch for earnings dates. Follow these 6 steps and you're going to outperform 80% of options traders on execution alone. Okay? Now I'm talking to my futures traders real quick. All right, so for futures, this is a different beast. It's faster, it's more leverage, it's tighter spreads. The order types are more nuanced and the execution environment is different from stocks and options, okay? So look at the blue banner at the top. Look at the blue banner at the top where it says tight spreads and futures make market orders more acceptable than options. But limit orders still improve your field. So what I'm saying is you can use market orders when you trade in futures more than you can when you trade in stock options, but you still can get busy with the limit orders. It's still going to help you when you trade in futures. All right, so let's go through the future specific orders. These are the ones you probably haven't heard of, but you will constantly use if you trade futures. MIT, market if touched. Market if touched. This is a buy order placed below the market or a sell order placed above the market. When price touches your level, it converts to a market order and it fires. So let's say the E-mini S&P is at 4,600. I want to buy a pullback at 4,580. I place a MIT, which is a market if touched. I place a buy at 4,580. So if the price pull back and it touches 4,580, boom, a market order, I'm in. Guaranteed fill. This is how they buy dips without watching the screen constantly. Now I'm going to do a limit if touched too. Same as an MIT, but when touched, it converts to a limit order instead of a market order. You got more price control this way. But it is slightly less guaranteed of a fill. You might not get filled, but you use this when you want to buy the pullback, but only at a specific price. See? Now the bracket order. I can't stress this enough. Use bracket orders on every futures trade. Every single one. You set your entry, the moment it fills, your profit target and stop loss fire automatically. You are managing your 3-to-1 risk to reward on every trade without being emotional about it. Them people that tell y'all don't use a stop loss, I despise them. I block them. I unfollow them. I don't want that type of fuckery in my life, and y'all shouldn't either. But y'all sit and listen to people tell y'all not to use a stop loss, and it's just horrendous. All right, now let's go to lit. It's lit. Oh, we already went to limit if touched. We did market if touched, limit if touched, bracket order. Let's talk about stop close only. Stop close only. SCO orders. Stop close only. So you want to use, this is a swing trader secret weapon. Stop close only. It's a stop order that only triggers at or near the close of the trading session. All right, so if the price spikes through your stop intraday, if the price go through your stop loss in the middle of the day, maybe a news spike or a fake move, it doesn't trigger. It only matters at the close of the day. This is powerful for anyone holding overnight futures positions. It's going to keep you in a trade through normal intraday bullshit, but it's going to protect you if the close confirms the move that happened against you. Sometimes, sometimes, hey, it just went down a little bit, but at the end of the day, it went way where I wanted it to go. That's where a stop close only would have been good for you. Now we got the trailing stop for futures. You want to set your trailing stop in ticks or in points. As the price moves in your favor, the stop loss will follow the price going in your favor. It never moves against you. The key to the trailing stop is setting it wide enough to breathe. Okay? Wide enough to not get stopped out on normal fluctuations. You want to use an indicator called the average true range. Okay? Sunday, I will be doing a live stream about indicators. I'll go over the average true range then. But you want to use that as a guide. If ES typically moves 8 to 10 points in a normal chop, don't set a 4-point trail. That just don't make no sense. Okay, and then we got the iceberg or reserve. Institutions use this to hide how much money they putting into futures. Like they don't want you to see that they using a lot. So yeah, you'll see that in the DOM. Now you can see them when you reading the tape, and you'll know what you're looking at. Now I'm about to leave y'all with something that's valuable before I end the show. This is a cheat sheet that y'all can take with y'all. This is a cheat sheet that you could take with you. All right, we covered it. We covered a lot tonight. And I know it's a lot to take in, so we'll bring it all home with this cheat sheet, okay? And this is something that I'm going to leave this up while everybody has a chance to screenshot it, write it down, whatever, okay? If you support me, I'll send you every slide that I did on this show tonight. I'll give you the whole slide. Or I'm also going to give the replay to my clients in my Discord. This will be posted in my Discord. All right, so let's see. What do we got? Let me walk you through the decision framework that's on the left. So this is the questions that you want to ask yourself before you place any trade, ladies and gentlemen. First of all, do I need to exit right now? Do I need to exit right now? If I'm in a trade, do I need to exit right now? If yes, then market order. If no, then we keep reading. The next question I should ask is, do I want a specific price? If yes, then you need to use a limit order. If no, then use a market order. Do I need automatic risk management because I have a hard time getting out of a trade, whether to take profit or to stop a loss? If yes, then use an OCO order or a bracket order. Am I trading options or futures? Oh, I'm trading options? Okay, well, I need to be using a limit order out the gate, unless otherwise. Oh, I'm trading futures? I can use a limit order, but really, I can use a market order because there's so much liquid here. Now, how long should the order live? Should it just last today? Do I want this order to get filled tomorrow? Or am I going to change my mind and I don't want it to be filled tomorrow? Oh, I want it to be filled today? Okay, well, it need to be day. Oh, it's a multi-day swing? Okay, I need this to be GTC, good till cancel. So run through this checklist before every trade, especially when you starting out. It becomes automatic within a few weeks. But this is your at a glance guide, right? Every order type, whether it controls the price, whether it guarantees a fill, and what it's best for. Laminate this shit, put it next to your trading setup, do whatever you got to do. Okay, but look at the 10 expert rules right here on the bottom. Rule number 1, never use market orders on options. Always limit, especially because you're dealing with wide spreads. Rule number 2, always check the bid/ask spread before any options order. Rule number 3, start at the mid price. Adjust towards the ask if you really need to get in. Because the ask is more. Go. Hey, rewind it and watch the beginning of the show if you're still confused about that part. Now, rule number 4, use bracket orders for every futures day trade. Rule number 5, set your stop loss before you enter, not after. Rule number 6, OCO, okay, that means one cancels the other, equals profit target plus stop loss in one step. I use that shit every time if I was you. Rule number 7, this for the futures trader. Stop market is okay, and options, stop limit only. Rule number 8, good till cancel, okay, or GTC plus limit equals the swing trader's best friend. Rule number 9, never place market orders pre-market or post-market. The spreads are brutal. Rule number 10, risk no more than 1 to 2% per trade. Your order type enforces your plan. The last rule is the most important one too, by the way. But here's the thing, every single order type that we talked about tonight is a tool for enforcing your trading plan. The stop loss enforces your risk. The limit order enforces your entry price. The bracket enforces your risk to reward ratio. Yeah, trading isn't about being right. It's about managing the times when you was wrong. And the order types are how you do that. So you came in tonight not knowing what an order type was. You leaving knowing about 15 of them and when to use each one, how they work in options versus futures, and how professionals string them together and manage entire trades automatically. Y'all, this ain't a small thing. This is a real edge. Congratulations. Because now you know the answer. If you're still confused about this, please reach out to me on a personal basis, right? I don't mind helping you out on a 1v1 level. All right, y'all enjoy the rest of y'all night. That's it for the show.